share my screen. And what I'm going to highlight here is data related to our model portfolios. And I think I've explained before. Again, by the way, if you haven't done this before, thank you for being here. We only have 2 rules. If you would, mute yourself while we're talking, because, you know, like our dog can bark and you don't want that happening. And then ask questions, if you would. So here's one of the ways that we look at these data. It's taken me a moment. Okay. So we run internally, we're running 4 model portfolios. And I wish they were, you know, we've learned a lot. We don't do all of the data science before we share things. We do vigorous data science, and then we begin, and then we learn some more things. But what you're looking at are, and I've realized the print is small. It's an internal document. You know, we're just sharing it here. It's not really meant for public consumption, but we'll do this. So this is just comparative performance from the beginning of the year to present, and we're getting close to the end of the year with SPY, the purple line, and then these model portfolios. Well, they've all outperformed. The 2 that we have shared are the top 2, of course. And you know, we shared we used first just the focus momentum portfolio. I mean, why do anything else? We could see that the low volatility portfolio was doing well too. But we then launched that because it was outperforming. You know, this is the low volatility. This is the momentum portfolio. As I said, since September, options expirations, it has not worked. Okay, we switch horses. You know, that's the thing. The market changes, behavior changes, rules change. I highlighted today that there was a rule. I didn't even catch it, but there was a rule change at September options expirations. It's probably a false correlation. I don't know if, you know, did it have any bearing? Probably not. But the CBOE, what used to be called the Chicago Board of Options Exchange, they just call themselves CBOE now. But you know, they're a big provider of options and futures, and they changed some rules. Everybody is doing this. They're trying to migrate toward global trading hours, GTH, but they changed when trading ceases in AM-dated index options that expire monthly. That happens to be today. So up until September of 2025, those would expire. They're AM dated because they settle in the morning. That's really why. But they would finish trading at the close today. And we have always tracked that. Well, now they will continue to trade just like futures markets tend to do until about 9 a.m. Eastern time tomorrow. Now, I don't know what bearing that has, but because they're on the S&P 500, they have all kinds of them. But in this particular instance, it's the S&P 500. And so, you know, there's quad witching tomorrow. I don't know if there's a full quad, you know, options and futures on stocks and indexes. It's why it's called quad. There's the 4 things. But now, right before the open, and I think, you know, that the global trading hours are, call it 8:15 p.m. Eastern time to 9:25 a.m. Eastern time when futures trade. It's the global trading hours outside the U.S. You know, the exchanges, they want to get all this stuff aligned. I don't know if that's good or not. I mean, I have a very strong opinion about what the purpose of the equity market is supposed to be. You know, it's supposed to be a place for public companies to assess the cost of capital and access capital from people and organizations that are willing to take risk in growth enterprises. Well, what is it now? I can't tell you what it is. I can tell you that the things that are derived from what is in that market trade vastly more than the underlying stocks. 0 days to expiration options alone trade $1.5 trillion a day. And the underlying entire stock market trades, call it give or take. We've been as high as $1 trillion a day, get running along at $700-800 billion a day right now. So clearly, that's no longer the purpose. I'm not sure what the purpose is. But anyway, I don't know what effect this has, but it will dovetail into what do we do under these to make money? Getting to the portfolios, clearly we were really delighted with the focus low volatility portfolio. You could say, it just continues to give us things. Sometimes the turnover is quite high because it's math. Just when the criteria change, and it could take just a little bit, we have to rebalance. But you're only doing a couple of things. We aim for 5 stocks. Sometimes it's got a little more, sometimes a little less. But it continued to way outperform SPY. Now, in the last, call it since November options expirations, once again, you could peg it right there. Neither of these portfolios has performed well. I mean, frankly, neither has the whole market. It's flat, but it certainly didn't decline like our model low volatility and momentum portfolios are. So we have to switch horses again. You say, well, where would we go? And you look at the data and say something related to fives appears to be better. And we're working on that. We could do a portfolio now. The problem is all of them keep finding the same things. I think this is true all over the market. The market finds the same stuff over and over. It's one of the problems, concentration risk. It's no big deal so long as markets rise. Concentration risk is only a threat to us as investors and traders on the way down. If everybody owns the same thing, we all benefit on the way up because there is, more money chasing the same goods. On the way down, we will jostle against each other trying to get out, and it will be a mess. And it will happen at some point. I don't know when, but these are the issues. So when we cannot find a good solution, we tell you, and we've continued to produce the portfolios. I'm inclined to sideline the momentum portfolio for the moment. It did very well during the correction. I mean, if we have another one of those, and you never know, I don't know what's going to happen. I can talk about, we bat that around at the end, what we think lies ahead. But then you return to the horse that outperforms. It's very interesting that it is not performing now. What's the cause? Well, the stuff that drove that return isn't doing it. Which leads me into the second thing that I wanted to highlight here, which is this is data, and hopefully you can see this reasonably well. I should probably, I can get it adjusted just a little bit better. Maybe I'll do this. Okay, so this is data. It's from November. It just happened to be where the data set was. I wanted to run a year's data, and the systems we use to kick the data out tend to have a little margin around it. So it happened to be November 14, 20. There was no purpose behind that, just what the data spit out. So I made sure that both data sets matched. And I did this. I took this red line is a compilation of the stocks comprising the S&P 500. We license S&P 500 data or S&P global data, and we try to keep these things all aligned. Sometimes there are 504 or 5 or 6 stocks in the S&P 500. Could be that there'd be 499. We have additions tomorrow, including Carvana, if you can believe it. Carvana in the S&P 500. They've made it. So we take all of the stocks comprising whatever the index is, and we add up all the prices and divide it by however many components there are, so we get an average price. So the average price is at present, call it around $226 would be the average price of a stock in the S&P 500 without any weightings, just taking the prices. We just track that over time. And what's fascinating is not only has if you take the average price of all the components, it is the same. It is actually up 1.3% over the last trailing 12 months. So be, December 19, 2024. That's it. Well, meanwhile, this is SPY, which mirrors SPX, which is a futures contract from the SIBO. It's S&P, but it's SIBO runs it, is up close to 15% over this whole period of time, and call it 12, 11.5, 12, depending on how the day goes today, for the trailing 12 months, the year. And up 16% year to date. So how is it that this is true? And Brian and I were talking about this. The logical answer would be weightings. So there's a small handful that has caused the index, which is a futures contract, to dramatically separate from the underlying baskets starting in May, at May options expirations, almost always at those points in time. Now, maybe that makes sense, but our position on this is then it's not the S&P 500. If the index, the measure of the underlying components doesn't comport with the performance of the components, that's not really a good index. I don't know precisely why. I could offer reasons. Maybe you could say, well, there are 6 or 7 components, the big tech stocks, because they're such massive weights that explains the difference. But it is a spread of astonishing proportion. And I look at that and say, well, that's not normal. And historically, it's not really the case. And I want to look at some data further back. But it's an interesting thing. Are all of these things related? Is the breakdown in performance? Is the snapback conditions in the market, these violent moves in the market, are they all related? I don't know. We don't know. We track demand, supply, and volatility. That's what we trade. But I find that I share it for thought. And if somebody has an answer, I'd love to hear it. You could say, well, you could get to it. Couldn't you assemble the contribution on a weighted basis? You could. And it would be interesting. I haven't done that. Maybe we should do that and see if it jives. I believe it has to do with excessive demand for derivatives. I think we have so crowded the market with derivatives that they have an inflationary effect. Now, I don't know, but that means it has to reset at some point. Really quickly on IBKR, that we're not going to give our IP away. Just not going to do it. And they were not willing to offer us enough to make it compelling. So we said, no, thank you. And so we're going to go our separate ways, and we'll find another partner. That's I want to plug our I think we have a very good approach. I think that we have a groundbreaking way to think about how to trade the market. Instead of trading price, you trade demand supply imbalances. I mean, technical signals don't reflect the fact that most prices are set in 400 millisecond increments. It's why futures contracts aren't a great read if they're constantly repriced by machines. We're trying to use this a little more. So we'll see how that all goes, but that leads into my final point, and then I'll hand it off to you, Brian, which is, what do you do in this market? If the model portfolios, which have really just crushed it, have stopped crushing it, what do you do? Well, you can't use them. When we'll tell you if they're not producing returns, then we don't want to use them. I want to look very hard, and I did. I've got, but it's just, we have to vet it. We call them fives. It's this. If a stock's spending a lot of time at 5 that have falling supply, it's just difficult to get away from the dominance of tech. I mean, no matter what we run, if we prioritize by market cap, we keep coming back to the same names, which is then happening to everyone. If it's happening to us, it's happening to everybody who is trying to do well in the market. And so it's a challenge. But that condition seems to be closing the performance gap, while momentum and our focus low volatility, which will still look for deviation between demand and supply, hasn't done so well. But what I conclude, it's very simple. If broad sentiment is doing this, and is it gonna rise again? Well, it might. Could be a double top here. So we've got demand supply slight divergence. You have a sharp market move, although it gave a lot of it back there for a bit. On inflation data, that's because options are resetting. Everything has to be repriced. Tomorrow you've got all these index products that have to be conformed, they're supposed to be anyway, to their components. And if you have a lot of movement in those components, then you use baskets of options, puts and calls. You're overweight something, maybe a basket of puts gets subtracted so that weighting is back in line with where it's supposed to be. Or if something is deficient, you buy calls so that you fill up the deficiency and get you back to the measure. That stuff happens tomorrow with new options trading Monday. into this environment. But I come back to the conclusion: look, if broad sentiment is challenging, there are derivatives expiring. You sometimes have to sit out. We ran this. I can't replicate. It's one of the problems with AI. I have a difficult time replicating an outcome. You could give a bunch of statistical or mathematical instructions and then do it the next day, and you will get a different outcome. And I think it's because it's generative, and then it causes me not to trust the outcomes. But very simply, we ran some data. Like, what happens if you had a long-short strategy using demand and supply, and if you and a 50-day horizon, and if you at 7, which doesn't happen very often, if demand was over 7 and you shorted the market, and below 4 you went long, according to Grok, when we ran this data for a period of 5 years, it produced an astonishing return, well over 68% annualized. I don't believe it. I think it hallucinated. But it was only in the market 26% of the time. That's the point. We shouldn't have to be in the market all the time to produce returns. In fact, that's how you produce, alpha. How you have a high Sharpe ratio is if you can produce the same returns or better than somebody else, but in much less time. And if you could do it in a quarter of the time, then your money's not at risk. You can have it riskless, you're generating a modest return. And then when the market conditions are right, where you can produce a good return, you take those returns and you repeat that over and over. Daily trading ideas, they have continued to work. And I think Brian's going to talk about that. The moral of the story to me is you have to adapt to the conditions. And really, our aim isn't to be in the market all the time. It's to be there when we know we're going to get a return. And when those conditions deteriorate and we lose our assurance of a high probability, low risk return, then you have to change what you're doing. Anyway, that's where I've arrived. Comments, questions, thoughts? Brian, I'll hand it off to you nonetheless.
Thanks, Tim. Just finishing writing up one answer. A quick question for you, though. There was a question last week whether your discussion was available, if that was possibly recorded.
Oh, from what was it I was going to share? I said I would do that, right? What did I say I would share? Oh, what I shared on Schwab, Trading 360, which you can replay. Not that it was brilliant. I just made these points. That why is it that futures contracts have become unreliable signals of what the market will do? Sometimes it is. And statistically, it's still better than a coin flip. But the reason why that is true is very much that we have global trading in derivatives markets, and the dominant price setter has an investment horizon that's very short. It's called Susquehanna. Susquehanna is trading things, and I always use 400 milliseconds because that's the blink of an eye. Blink of an eye is 400 milliseconds. If that's your investment horizon, it will continually change, and the outcome that exists right now may not be later. That's what I talked about on Schwab. And I talked about how volatility at transitions from 1 month to the next has increased. And I attribute it to perhaps the same thing that we see in this spread between SPY and the underlying basket. There is over-dependency on derivatives because they're easy and flexible and elastic, and it's very easy to use them instead of buying the underlying securities. It becomes a crutch. And it will manifest in sudden lurches in the market because derivatives can be instantly marked to zero. Can't do that with an equity. That's my comment. That's what I covered, basically.
Thank you. As Tim mentioned earlier, thank you so much for attending these sessions with us. We really appreciate it. We appreciate the interaction. We appreciate the questions and your support. It means a lot to us. So thank you very much. Wanted to cover a couple of items here. I might pick up on a couple of thoughts that Tim mentioned as well. I'll go ahead and share my screen. First item is just the daily trading ideas. In general terms, nothing obviously in the stock market is 100%. But if we look at the daily trading ideas, and I've mentioned this before. What I'll do every day is I'll drop them into just a watch list. So here's our momentum list today. Here's low volatility, and I'll show you what momentum looks like right now. So many of them are doing quite well today. As an example, and you guys, and rightfully so, will often ask, well, how can I trade these? What's the best time of day to trade them, and what have you. As a general rule, Tim and I will tend to get into the names towards the latter part of the day. I'll give you a couple of examples from yesterday. Both LRCX and PLTR were on the list yesterday. It was a tough day in the market. And what had happened is both of those names had lost all of their volatility. And what do I mean by that? So if you look at the momentum portfolio today as an example, you'll see the volatility. That's the daily intraday volatility. And I think for LRCX, it was 8% yesterday, something like that. It was down more than 8%. So it had lost all of its volatility. There was no news in the stock. So if there's news in a name, I'm not going to touch it. But if there's no news and it's just down with the group, but it's lost all its volatility, what's the odds of it recovering the next day? I mean, it's fairly strong. So I placed trades in both of those yesterday. Once again, the reason was I was just looking at the intraday volatility and I was trading off of that. One other item that I'll sometimes do is I'll look at names at the end of the day, and I'm looking for names to be in the range. So I'm looking for them to be between the entry low and the entry high. If it's past the entry high, that's just a hard pass. I'm not trading it. What I'm also looking for is a little bit of underlying strength. I'll give you an example. I picked up FCX yesterday. It's not doing too much so far today, but it was doing a little bit better than the broad market on a weekday. I was like, okay, well that's doing a little bit better. I'll take a chance on that name. Maybe it'll give me the performance tomorrow. But that's some of the things that I'll look for. I'll look for underlying strength. And I'll look for, hey, is it really getting clocked today for no apparent reason? And a lot of times those will then, recover during the next day. So just a couple of thoughts there. I will circle back to our model portfolios for a moment, and I'll give you a thought, perhaps what might be happening in the background a little bit. And I think I mentioned this last week. And I'm going to back this look up a little bit farther to show you what's happening. And I've mentioned this 2 or 3 times. So if you're always on these calls, I apologize for repeating the same thing, but I do think it's important. If we look at the normal rhythm of the market, and I'll have to back it up more to show you what the rhythm looks like, there's an ebb and a flow to the demand cycles, and it looks something like this over time. We're routinely moving above the red line. We don't move below the green line very often, but there's a rhythm to the market. And you can see what has started to happen here during the last few months. Those demand cycles, for now, have started to break down. Maybe this most recent one has changed that cycle. I'm not 100% sure on that, but you can see a breakdown in those cycles. And it started to break down August, September, right around that time frame. If we look at what has happened to the momentum portfolio, when did that start to break down? Around September, around October. It was around the same time frame. So I think that's probably a contributing factor, is we're just not having the same momentum in the market from those demand cycles that we've had in the past. I did want to mention something about the low volatility portfolio as well. If we look at what happened here, so this particular move higher actually coincided almost exactly with the end of options expirations. And Tim mentioned it earlier. You'll hear us talk about expirations. I mentioned it in the note this morning. There's an inflection point. So these green squares that represents expirations activity. I think the 20th was the same day that Nvidia reported. The whole market turned over, and then the whole market started to go into rally mode. Why was that? Everything was oversold. It was almost a repeat. If you move it back a little bit, it was almost a repeat of April trading. Everything got extremely oversold. And, there was the big rush coming in the door to pick up those oversold equities, and the market rallies. So a little bit of a similar phenomenon here, but the point was it was at an inflection point. Where are we coming up here right now? We're at a potential inflection point. And once again, we have trillions of dollars. And let me show you what this looks like. This is slightly dated. But this information is from June 2024, about $8 trillion of notional value equity derivatives. When is that going to reset? Usually on a monthly basis. So think about what market participants are doing in the background. They're going to be rolling contracts. They might be adding to contracts. They might be subtracting from contracts, or maybe they might do nothing at all, which would be similar to subtracting from contracts. But when you think about trillions of dollars all making those decisions at the same time, that's why you can get volatility during expirations itself. Let's move over for a second to our tech sector. It's been strange trading recently. There's just no other way to explain it. And let me show you what's happening here. So as the broad market came under a little bit of weakness for the longest time, tech was just staying 7.778, but we're talking about 361 companies. So what was occurring there? And I think to a certain extent we had a big tech effect. So what I did is I dropped all of those companies. You're looking at the tech portfolio, and I just did a sort. So I sorted them by demand, and then I sorted them by demand trend. And when we look at all of those companies, and you can see them, circling down here, there were 244 names that were above neutral. So five or above. But during that same period, tech has been coming under pressure. I think tech was down about 5% during the last week. So how can those two things be true at the same time? Well, I think part of it plays into what has been happening behind the scenes with our big tech portfolio. So if you look at big tech, and you'll hear us, go through this theme over and over again, if big tech is suffering, the broad market is going to tend to suffer. What has happened coming into expirations? Well, big tech has been under pressure. Big tech has been under pressure. What has that contributed from a market perspective? That's not the only reason, of course, but the broad market has been under pressure as well. Very difficult for the market to perform well if 35% or so of the market is suffering. But remember back to what we just mentioned a moment ago. Big tech was under extreme pressure right through here. What did it do afterwards? It screamed higher. And what did our model portfolio do afterwards? It screamed higher. Almost that entire move was right after expirations, when big tech caught fire and low volatility moved higher by about 10% in the course of like 4 trading days, something like that. So a lot of times those can be related in terms of that performance. I did want to share, and I think I have time to do this, one aspect of what might be occurring. And Tim mentioned this. Could we possibly see a double top here? And let me share with you what we mean by double tops.
And while you're doing that, AJ asked
Yeah.
Brian if peer news would be the same thing as an apparent reason to avoid something. Like going back to LRCX down all its volatility What about peer news?
Yes.
Does that factor in?
Yeah, yes, it does. Yeah, I will often avoid things when I see news from a peer as well, because you'll often trade in unison with them. Tim and I will do a lot of reports on the investor relations side, and we call it default mode. If a group is moving in a certain capacity, you'll often see all the components in the group moving in that same capacity. So yes, that will play into things. Wanted to share just a couple of examples here before we take a look at the path ahead. And what I want to show you is, what possibly happens when we maybe get a double sentiment top. So what we're talking about is if sentiment stops moving lower here and then starts moving higher again. And I'll have to circle back. Oh, well, here we go. We can see it. So this is the first example here. You can see how sentiment, this was back in January of 2023. Sentiment moved a little bit below neutral, kind of what we're seeing right now, and then, started moving higher. What did we see from a broad market perspective? Everything kind of flattened out for a period of time, and then we started to catch that rally. If you look, another example, this was December 2023, kind of moved lower below the red line, immediately jumped higher. The market was in rally mode. But, in general terms, you might get a stalling out for a period of time, but then usually that thrust higher is usually pretty good for the market, kind of similar to what we saw here in April. That was a huge move. That was a huge outlier above being above the red line for that period of time. One cautionary note, and I mentioned that, like these double tops tend to be constructive for broad market returns. They are, unless you're in a bear market. And obviously we have not been, but if we look at 2022, we were in a bear market then. And what would we tend to see in that type of market? You can see a couple of examples here. That was a double sentiment top. You had just this brief rally higher, and then it fizzled out. You get a double sentiment top here, brief rally higher, it fizzles out. You see the same thing happening here. So it was happening over and over again in a bear market. Are we going into a bear market? No idea. And maybe I'll start into the look ahead. But and I've mentioned this I think 2 or 3 times in a row now. I am watching these demand cycles here as we move towards the end of the year. It's always difficult. You're comparing, apples to oranges, but the most closest example I can look at is going back to 2021. Demand really weakened back during that time frame. It didn't manifest really for a couple of months later. When did it manifest? At the beginning of a new year. And that's when we moved into a bear market. So that is something that I'm watching as a potential inflection point. I have no clue, whether we're going into a bear market or not. But what I do see is that weakness that's been manifesting in demand. And, could that potentially be nullified by demand now starting to increase? Sure, that's a possibility. But from a big picture perspective, as we get closer to the new year, just be aware of some of those dynamics. Just be, perhaps a little more cautionary at the beginning of the year, just in case there's some weakness in the background. That's more of a longer term perspective. For me, in the short term, what I'm watching for is just a potential inflection point. Once again, November was a clear inflection point. We saw a sharp move higher. Where did it happen? Once again, right at expirations. Where are we right now? Once again, at an inflection point. So in the short term, look for potential strategy changes. I think from a longer term perspective, just be aware of what might happen at the beginning of the year. Tim, I'll let you share what, yeah.
Oh, I've just Brad, to your question about the VIX and options volume. I don't know. Honestly, I don't have an answer for you on that. I admit that my bias toward the VIX is that it's a lousy leading indicator. It's, I mean, it once it happens, it's telling, but whatever causes that, let's say a VIX spike to occur, which is not an answer to your question about volume, just behavior. You've missed it. So and that's a real challenge. And it's one that that I have made money on and lost money on, because I have certainly, there have been times um, I have expected volatility that doesn't manifest, and it will cost you money. And I have expected volatility and it did manifest. But I don't know the answer from a volume standpoint. It's very important. We have noticed that when volatility subsides, that's when trouble looms. It's not a deep insight. You can watch volatility and SPY go down by half, and that the trade's likely to change. I don't have a good answer to you for you. To the question about what's ahead, it's a challenge, because I would look at the data that Brian was talking about, and clearly we don't have the conditions that we had preceding the 2022 bear market. By which I mean, and we'll wrap this up here pretty soon, but it's the last time we'll do this until 2026. We won't do one that last week of the year. You have things to do, and so do we. But I will note what Brian was pointing out here. And Anesh, I would just double check, because we had looked at RSP, the equal weight, and I just wanted to confirm my thinking there. Here's going back to what Brian pointed out. I'll just want to note one thing. Maybe I'll do 5 years back. And again, what happened in the past may not be the same as what happens this time, because the data are continually changing. Why this is so slow here, but it's been an issue on this machine. So here's what I mean. Here you had this was a big covering event followed by a steady upward rise in short volume. Same thing we had here. And yet, in some ways, this is the opposite of that. So is there anything telling? No. All you can do is say, well, what's occurring now doesn't really look like that, save for this. I do the same thing. Brian and I have talked about this. It's why I had the feeling that it was highly possible that we could break through the green line right in here at these very volatile points, and we did not. We snapped back. And I wrote that I think the bungee cord will break. At some point, there will be no snapback. We'll just go right into the ravine, but you don't know when that's going to occur. What would cause it? Once again, it's, to me, pretty simple. There are flows into the market, and there are prices set by machines, and they have opposite time horizons. Money runs on models, and it's allocated in many ways, like target date, balanced, diversified, and machine set prices. And there's a lot of derivatives. Derivatives become a smokescreen. You don't really know what's wrong until it's too late. Kind of like mortgage-backed securities. I mean, we didn't know that we had extrapolated out an expectation for the real estate market that didn't transpire until it was too late. Some people saw it. Right? So I look at that and say, well, is there anything in this pattern, the demand side or the supply side, that would portend a collapse? Well, no. And in some ways, that's almost the whole problem. I have observed privately that I think we are too quick to put this year in the books and say, man, it's been another great year. Well, the year's not over yet. In 2018, we had a correction in late December. I'm not saying that's going to happen. I can't look at the data and tell you, but I certainly want to share my thinking. And, Candace, you said, well, I'm sitting out. Been a good time to sit out and avoid the chaos because you can't time it. I sold my long hedge when the market was up 1% today. Now, I may reset that. I'm just trying to take whatever if the S&P 500 is up 1%, there's all the volatility basically. We know, so might as well take that gain. But then you have to adjust for tomorrow. I don't know what tomorrow is going to bring. But if you're sitting out and you're asking, Candace, is next week going to be good? Well, I'm very cautious about this because I think it could break. And I don't have a good, what would give me the reason to conclude that? The amount of time we've gone without cutting below the green line. It is an extremely extended period for that, particularly given that demand has weakened. Why didn't the market break down at these points like it should have? And I would say again, it's been derivatives, so it will catch us out. And I think part of the problem right now is no one is expecting it. No one is prepared for it. There are no hedges for it. There's been enormous amounts of covering in big tech. I mean, you can look at all the demand supply trends. And of course, the high speed traders remove supply so that they can capitalize on a movement in the market that they anticipate to. They all run models. We run pattern models. We can say if a pattern lasts this amount of time, 5 days, what is the probability that it will last 5 days again? Very high. It almost never doesn't. So if we see a big pattern of, say, passive investment that is buying or selling, what is the probability that it will take a certain period of time for it to return? Something else will replace it, it goes away, and it returns. And what's the probability if you look across here? All of these declining lines on the supply side, they're everywhere. And it's clearly an expectation that the market is going to do what it has, which is it declines. And remember, I said, well, the market's likely to go down more, which it did yesterday, because just looking at each of the periods in the last 3 tops, the nearest data is your best informer because it's the one most reflective of current behavior, rather than looking back years and years ago. Because the behavior was different, the flows were different, the use of derivatives was different, the pricing was different, the dominant stocks in the market were different. All of those things are different. So believe it or not, shorter term is a better indicator. That we would decline some, and then if history repeats itself, we snap back. So is today the snapback? Well, I don't know. Dow's only up 120 points now. That's not material. It's not meaningful. It's within the volatility range. So I don't know. But one of these times, it's just the person representing the market is going to jump into the ravine on the bungee cord, and it's going to break. And I think there's a risk of it. Of course, I always think that. So keep that in mind. I always expect that when there's a breakdown. Joe, to your point, October 10, to me, that was shoe number 2, but it hasn't dropped. That was the consequence of April, and it just hasn't unfolded. You can't tell how long it will take, but it was the beginning of whatever's going to happen. And I don't believe, looking at the data, that whatever happened, we're going to just rocket sled off again. Why? Well, flows have been committed. I mean, look at the cash levels. We're at record low cash levels at institutional investors. They've put money to work. Now, if the market drops 20%, I will put money to work in my longer term portfolios. I'm not doing that right now. Long term, not edge trading, daily trading ideas, not even model portfolios, longer term stuff. I will not do it. I'm not putting any more money into the market until it gives me an entry point, which is a steep drop below 4. And we haven't had it, and I'm content to wait for it. It'll happen. And then it'll happen again. No one knows when. So I would be very careful here. Even Tom Lee said, Tom Lee Fund Strategy's on all the time. Like me, he's wrong. But he's right a lot. I mean, he's a smart guy. He said, well, I don't know about the beginning of the year. A lot of people say, well, the correction is going to come in 2026. Well, if everybody expects it, that makes me unsettled, because when everybody expects it is not when it tends to happen. And so I think, well, what is not in the next year? Well, between now and December 31st. So I'm just going to be pretty cautious between now and then. That's my view, and my view alone. That's all. So we'll see what happens. That's all I've got. If somebody has a more positive thing to say, it would be good. I'm just reading your note. Elliott waves. Yeah, I mean, yeah, I'm certainly, I can't say I'm, expert on Elliott wave theory, but there is always merit to those things. I mean, there are measures of human behavior. I'm a skeptic of technical signals, because I know that Citadel, Jane Street, and Susquehanna are not using them. All they're doing is modeling gaps in very short increments, and they don't conform to technical signals, and they dominate the market. I mean, sometimes Citadel is 50% of market volume. I mean, it's crazy to be that reliant on one firm. But your point stands, Brad. By the way, for the recording, Brad said, I realize I have a different background on watching the markets, but another reason for the model portfolios not working as well lately from my work on Elliott waves was completed on an impulse up wave October 9th. And it's been a corrective zigzag ever since. Okay, yeah, I mean, it might be right, but my technical analysis skepticism. Seb, good to see you too. Joey, thank you for being here. You guys all have a great break, and we will see you the week of the 5th of January. And I hope I will have, I don't ski over Christmas. I mean, there are too many people. And if there's no snow, you're just asking to be wiped out by somebody, some visiting riffraff. But I hope in early January we've got some snow. So enjoy. Anesh, good to see you. Thank you. Candace, nice to see you. You guys take care.